lot of our customers are largely tech savvy with the penetration of mobiles by around about 95-96% in Kenya especially. And this all came with the revolution of M-Pesa many years ago. We're seeing customers are looking for services from the banks than coming to the branches. So we've been investing in our new platforms, payment platforms, algorithms for credit for customers, onboarding our customers now from their mobile devices. They don't have to come to the branches, and being able to deliver them a credit score. And so far we have more than 10 million customers on this platform. In fact, if you look at all our customers of 15 million, more than 2/3 come through on the mobile price. Now what we are seeing in the future is more than 80% of our business in the bank will actually be driven from our digital channels, and especially mobile. Obviously, we've learned to adjust to the new environment of interest rate cap. So now we are always in the second year of this kind of environment. So we've kind of learned the model of our businesses. We are seeing new loans growing up in manufacturing. We are seeing new programs in PPPs. For instance, what you're doing with the annuity model, what you're also doing today with the healthcare projects under Mike Masharia. So what we are running now is a different set of business. And obviously, we're seeing a lot of our businesses internationally doing well than they were doing last year at the same time. So the environment is good. The previous year was much more difficult, and we are looking forward. This 14% is something we want to do for the whole of this year of 2018. So it's a good environment. We're much more stable where we are as a business, obviously managing our cost. In the second half of the year, you will see much more investment. We'll be launching our own payment platform coming up that Huawei is doing. And that for me is a good way of ring-fencing our business within Kenya as the largest bank and in the region. Our large view is that we are putting all our funds into lending to customers. So we always have to balance between investing so we're not a bank that puts all our money in government paper. So if there's opportunities to lend to customers in the market that they are in, whether it's in agriculture or energy or financial institutions or manufacturing, housing or healthcare, our view, so you see our loans are up 9-10% in the first quarter of the year. And that's where we're investing our funds on. Now, the banking sector has been investing a little bit more on government paper and fixed income, largely because of the interest rate cap. But we are seeing our life beyond the cap as a bank. I don't think that is the banks are pushing for a repeal. I mean, what we are looking for is an open market environment for any sector. Correct? That's how we see it. Now, so what banks are asking for is the industry to go back into an environment where markets are available and you can determine your commercial rates. What we don't agree is the way the cap was proposed. So what the banks are discussing now is alternatives to provide affordable credit to customers, whether it's on SME as a sector, whether it's on housing, so that we can start looking at providing equivalent pricing for products that we have in the market. So the proposal we had before the interest rate cap is exactly what the banks are bringing up. We're saying we will listen to the risk-adjusted pricing for our customer. If yourself, Laban, you have got a better credit score, let's assume your credit score is 1 out of 100, or it's 100 out of 100, you should get a better price. If myself, Joshua, have a lower credit score, there should be differentiation on pricing for customers. And in the continuum, you get a lower average. That is what we are pushing for as an industry. Now, obviously it's a debate. I do not think that banks themselves have the solution. To be a partnership between the banks, the National Treasury, Parliament, and the Central Bank to find a joint solution that works for our customers. And ultimately, banks also must be responsible. The days when you are charging 25 to 30% interest for customers are long gone. And we are not asking for a repeal of the rates to bring back those old rates before. If that was to happen, then the banks would have failed their customers. Ultimately, the decision to repeal the law, we can do all the talk, all the lobbying. Yeah. The members of parliament will need to be convinced. As we speak, there is still what I call a wrestling match. As we speak, I propose that there will be some amendments. But what those amendments will look like is an issue that will be determined by the members of parliament when they discuss the finance bill. But we are positive. It may not be what the banks are looking for, but it will be an improvement of the current regulation we have today that caps the rates at CBR plus 4 and the deposit at 70% of CBR. IFRS 9 requires that we provide for our loans based on expected loss model in the industry. So that will mean that we need more capital. Yeah, we need to understand better the sectors we are operating in. We need to understand what drives their risks and where do they perform. And if there's a gap or a shock, then obviously you increase the level of provisions. So banks should be much more judicious. So for us, we have adopted IFRS 9 from 1st of January this year. Actually, we look at our first quarter results. The results reflect the adoption of IFRS 9. And from a capital point of view, we are still very solid today. So we don't have a gap. Although Central Bank has provided a window for 5 years for banks to comply with the capital adequacy ratios, I'm glad to inform you that we are already compliant from day one after the IFRS 9. It's a complex standard, I must say. And we'll spend more time explaining to our customers and our readers of financial statements, our investors and shareholders, what it means for them and what is different from the old model, which is IS39, and the current model of IFRS 9. My own view generally that if taxes need to be raised, as long as there's service delivery for themselves, there is no issue about raising more taxes. I think our concern nationally has been that taxes are being collected, but you cannot link what the taxes are doing in the economy today. So what I will suspect that will happen in this year is obviously there will be an impact on smaller businesses today. If you raise the taxes today and you can't provide the enabling environment, the investors who come to our country, the competitiveness of our businesses will be much higher, which more difficult to manage than other countries where we're competing against. But ultimately, I think Kenya has delivered. If you look at the World Bank index on the ease of doing business in the last 3 years, Kenya has made dramatic improvements in the continent. I think the only country ahead of us actually is Rwanda. So if you can deliver services into the country and to businesses today and ease their level of business, taxes may be the only way to achieve that objective. So let's deliver the services, then you can bring in more businesses. There is a lot of conversation on the consumer side. So using technology, particularly mobile, bringing in artificial intelligence, using robots to be able to determine customers. So the AI, the robotics, customer service, the apps that we are creating now for our customers, that's the self-service model is where we are going as well. And I believe Kenya is standing globally competitive in this kind of skill stuff. So that's running. But also on the corporate side, which now we don't talk about, the big projects, it's like the yin and the yang. You need your enterprises to run the race for innovation and transformation and pull along the individual customers. If these two are running collectively, then you got a fantastic case of collaborating and building our economy towards the 8, 9, and 10%. Thank you.